Morning, Dom.
Hey, good morning, Mike. With the S&P 500 looking to find some kind of buying support around these levels, we're floating right around the 50-day average price for the overall S&P. Some investors are taking a harder look at whether or not higher dividend-paying stocks are as attractive, relatively speaking, given the ability to actually invest in no-risk long-term government bonds at the highest yields in 7 years. Dividend sectors like utilities, consumer staples, and real estate, the traditional focal points, of course, of that rate discussion. In the age of passive index investing, a host of exchange-traded funds tied to dividend exposure have gained a lot of popularity. One of the bigger ones is the Vanguard High-dividend ETF. That one, ticker VYM. It's got around $30 billion in assets, has a current yield of around 3%, so higher than the market. It's also been, though, an underperformer versus the S&P so far this year. It's up 2%. The S&P's up around 7 to 8. There's also the ProShares Dividend Aristocrats ETF, the ticker NOBL, a $4 billion fund that has a current yield of around 2.5%, also better than market. It's up around 3%, so also an underperformer. And then there's the Spider S&P 500 Dividend ETF, the ticker SDY, an underperformer there as well. Now, if markets are in a rising rate regime, a big question for a lot of investors will be whether or not they find that mix of dividend yield and possible growth in these types of stocks is relatively more or less attractive than those attractive risk-free rates that are at multi-year highs, Sarah. Big question for investors.